Okay, we're recording.
Sweet.
So
Welcome to the first episode, guys. I don't know
yeah.
if we have a name for this yet. We could just call it like cousin money. I don't know, something stupid like that.
Well, what's that thing? Kissing cousins? Just call it money cousins or something.
Money cousins. Call it something like that. Yeah. Yeah. I
But
think our plan is here to basically help educate you guys about anything finance or anything investment related.
yeah, and I would say hopefully once we get a few of you, if you got questions and stuff like that, we'll definitely have some Q&A sessions, maybe each episode at the end or something like that. But we want to be really interactive and as helpful as possible. So
Sweet. So I think our the main topic we want to go over today. We'll just start with something super simple to us, but we'll see how you guys do. So basic ideas for savings. This could be like a pretty touchy subject for most people, just getting started into the whole saving mentality. But Alexander, I don't know, what are some of the basic things that we need for savings first?
um, I would say the first thing you really need to touch on and establish is a budget. But maybe before we get to that, like a bank account, right? I know I've had plenty of friends that don't even have a bank account. They just get their check, they take it down to the store or wherever they're going, and they cash it and they put the money in their pockets. Or you don't want to do that, right? You need to get an account. You need to go to whatever bank you want to go to. I do recommend either a credit union or if you think you're going to be traveling or you don't know if you're going to live in that area for a long time, maybe a big bank that's going to have branches across the country just for convenience. But get yourself a bank account. Make sure you have a checking account and a savings account at minimum. And yeah, we could touch on some other stuff, but because you need that. Like, because if you don't have a bank account, you're not going to have credit. You're not going to have a lot of things, right? So starting at the very beginning, bank account. So once you have that set up and you're actually depositing your money or getting an electronic transfer, however you're doing it into your account, you need to make sure you understand your budget, right? So a budget is, what's the best way to describe a budget? It's understanding of where your money is going and an agreement with yourself on how much of that you're going to spend on different sections or allocations. So you're going to identify how much you are spending on food and how much you want to spend on food. And then you're going to keep that promise or allocation to yourself, and you're going to keep that. Food, housing, entertainment are some of your standard categories. A lot of times people have like a auxiliary fund. I have one where there's a couple $100 set aside every month to, go out to dinner, or maybe we save it up a little bit and buy something special, like a fun fund. And then a big section of that budget is your savings, right? So when I first did my budget, when I was about 22 and I was really getting into this stuff, I made savings an expense. So I took my savings and I had it transferred to a different account every week with an automatic transfer of $500. So I promised myself, I said, I'm not going to spend, before I do anything else, I'm saving $500 a week to invest in my future. And that's going to come out before I pay any of my bills. And at the time, I think I was making about $800 a week and I was saving $500. And I figured out a way to live on, $300 to cover everything else. So it's just your commitment level. And like a budget doesn't help you if you don't keep it, right? So if you sit down, you take the time, you do it in Excel or use one of these apps out there that they have today, like Mint or a bunch of those other ones, and you come up with it, but then you don't follow it, doesn't help you. So it's about making it and then keeping it and then committing to it. And then, maybe having a accountability partner or someone that you can, bring into your life that you trust, that's done reasonably well and is successful in certain ways, and asking them to help you set it up and help you stay accountable, you know? So I don't know. What do you think, Dennis? Any thoughts on that?
Yeah, definitely. I think when I started saving, I was reading books on like basically how to better mentally prepare to manage money.
Yeah.
So I think the easiest way, I was a teenager, I was like 18 or 19. The best way, like you said, to allocate certain things for uh, like daily expenses. You have savings fund, fund, expenses. I had physical envelopes with just those things written down in each one, and then
Sure.
I'd basically just take the money from my bank because I could physically hold it. I could physically see it. It gave me a bit of a, what's it called? It made me value, I guess, the dollar a bit more.
Sure.
So I would physically just put it into each of these folders.
Yeah, you
And
could see it.
this was, yeah, this was like, I don't know, probably like $1,000 a month or something.
Yeah.
Because, it's not a lot of money, but it is when you're kind of that young, I guess.
Yeah.
But it helps you mentally prepare for that.
Yeah.
Because when you're dealing with bank accounts and just moving funds everywhere, it's like, oh yeah, it's just a number on a screen. But as you physically hold it, you realize, oh, this is a bit more than that. This is my livelihood. This is my future. You know.
Yeah. And holding physical currency is definitely, when you hold like $3,000 in your hands and you pay for something, it's much more painful than just swiping a
Yeah,
credit card.
it really is. Oh man. Ugh.
But unfortunately, it's not always practical either. But
Mhm.
yeah.
But yeah, if you're starting out, I think that's a good way to do it. Or you just take out a portion and then you can just put I don't know, whatever savings you have. It could be like a couple $100. Put it in the folder, and then eventually put it into an actual savings, a separate savings account, away from your checking where you get your paycheck every week.
Yeah. So you're not as tempted to like grab it or touch it or use it if you feel like you need to.
Hmm.
Um, I keep my cash savings in a high yield savings account. So it takes
Yeah.
about 3 days to transfer. So there's a thought process that goes into it. Am I moving this money out? And it gives you a decent amount of interest, which is nice as well. So,
Mm.
well, it did before
Yeah.
interest
What are
rates went
the?
to like zero. But
Yeah. What were you using? I think my sister had Perry. She had Ally, but I think it's like 0.5% or less. I don't know. That's the last
yeah.
time I checked.
So when I started it, it was paying out like 3.5%. I did American Express savings because I have a couple cards with American Express, and they didn't have any fees. So there was no fees on withdrawals or anything like that,
Mm.
which made it attractive after I did a bunch of research. And they had one of the higher rates and better service ratings. So stuck the money in there. And I mean, I think last year alone, I made $1,000 in interest. So, that's not bad for just money you're holding on to in cash for savings.
Hmm.
Um, and that rate is variable. So right now, because
Yeah.
mortgages are 2.5% and banks are borrowing money for nothing, that rate's like 0.5% or 0.5%. But still, it's way better than putting in a checking account, which earns you zero, or a regular savings account in a bank, which I think pays like 0.007. So
Yeah. Yeah. I think that's a good place to transition into, like, why would you have it in a savings account versus a checking account? Um, and that would probably lead to just inflation and all that. Why would you want it there?
yeah. Well, I mean, the number one thing too, right, is we're talking about budget here and savings. So
Hmm.
we touched very briefly on how to make a budget, and then how now that you have a budget and now you are saving money, like what you said with like putting it in an envelope, right? So whether you're putting it in
Hmm.
a physical envelope or moving it to a separate account, you need to get it out of your checking account because you
Hmm.
need to be able to keep it separate so you don't end up spending it accidentally, and also have the motivation of seeing that number increase as a separate account, and you can see that nest egg grow, right? That's fair. This whole thing with being disciplined, like you have to have rewards, right? You can't, it can't just always be hard. You have to be able to look in that account and be like, yes, like there's 10 grand in there now. Yes, I'm at 15, and like watch that grow. So having it separate's like crucial. It's like trying to like be on a diet and like you have ice cream in your freezer and you have donuts on the top shelf and like you're trying to not eat it, but it's in your house and it's like so easily accessible. Like you're always going to eat it, right? You got to get it out of the house. You got to get it out of the account and put it somewhere else so you can be safe. And like, if you have a moment of weakness, not just go and spend it.
Hmm.
So outside of that, like obviously now you've been saving. Let's say you've set up your budget, you're doing great, you're
Hmm.
saving. When do you transition from savings to investing, right?
Mm-hmm.
So, like you were saying earlier, like inflation, right? So if you just save your money and that's all you do, right? At the end of the day, you end up losing because over time, let's say 10, 20 years even, that money is going to be worth substantially less than when you put it in the bank. And if it's not growing at a rate of at least 3.5%, it's devaluing every year. So every year you're literally losing money, which is almost goes completely against the whole point of saving in the first place, right? Because you're trying to
Mm-hmm.
build a future and maintain value and build value. So how do we protect that, right? How do we fight against inflation? How do we fight against the fact that in 1950, your average middle-class worker made $1,000 a year and could buy a house for $3,000, and now that house is 654,000, right? And the average salaries, only about 40, but still way higher than 1,000, right? So um, you got to invest, right? Because that is the only place you can take your savings and put it into something that is growing at a rate equal to or faster than inflation. The amount and inflation, just to cover that, is that the government obviously prints money. In the US, we have what's considered a fiat currency, right? So the dollar that you hold in your hand is not actually tied to anything. It's just a promissory note from the government, in essence, saying this is worth whatever we say it's worth, and it's good for trade, right? It used to be tied to gold. We had a certain amount of gold, and they couldn't print more dollars than there was gold in the reserve. And then a certain president took us off that gold reserve and said you could print as much as you want, right? It was a bill that was signed, and that gave the government the freedom to just print dollars. So, and that's usually done by banks. Banks, when they create loans, right, when they give someone a mortgage, they don't actually go get that money. They just create it in the account, and that is where about 90% of inflation takes place. The government does try to control it, though. They say, we don't want rampant inflation like you'll see in some of these South American countries. So you have inflation rates that get astronomical, and it's $10,000 for a loaf of bread. So they try to control it to about 3.5% a year. And economists look at this and they say, this is good, right? Because populations grow, businesses grow. You actually do need more money in circulation for all these people, and the inflation keeps things kind of moving upwards and forwards, right? Makes everything get bigger and better. However, now that we've just covered that, just to make sure everyone understands inflation, if you just lock your money away in an account somewhere, it's not inflating. They don't send you inflation checks every year. It'll be like, hey, we printed, 13 billion more dollars. Here's your increase based on the amount of money you had to keep it equal. It'd be nice, but they don't do that. So you have to counteract that by investing. So before you start investing, because no matter what you put your money in, there's always some risk, right? You could put it in the safest investment possible. It's at risk. And there's other risks in life too, right? Like there's always the risk you could lose your job. There's always the risk that you could have a health crisis. There's always something that could come up, and you don't want to have that risk come together with the other risk of your investment at the worst possible time, and you end up in a very terrible situation. So before you start investing, you need to establish a baseline in your savings, which should be your emergency fund, right? Some people say that should be at least 3 months. Some people say it should be 6 months. Some people say you should have a year. It should be at least 3 months, where that if you lost your job tomorrow, you would have enough cash in that account as a savings account to cover your living expenses, right? Your groceries, your rent or your mortgage, your car payment, and your insurance. It should be able to cover all those things. And if you're paying your medical bills out of pocket, it should be able to cover that too, like your insurance. So if you lose your job, you have to go on, I can't remember the name of it right now, but your company has to offer you the same insurance, but now you're paying for it directly. You should probably find out what that insurance cost is and make sure that you have that money in that account to cover that. Otherwise, you're going to not have health insurance. Or have to figure out another means or methods to do that, which is something a lot of people don't think about. So once you've established that, right? Like, so let's say your monthly expenses are $6,500. You need $6,500 to cover your rent, pay for your car payment, your insurance, your food, everything like that. You multiply that times whatever your goal is, let's say 3 month minimum, and that gets you to like 19, 20 grand. Once that's established, right, in your savings account, I would personally take that money and put it in a high yield savings account in a separate place, right? Because that is literally not to be touched. It only gets touched if there is an emergency or you lose your job. That is what it's there for. It's a safety net. At that point, once that safety net's established, then everything else that goes into that savings account, this is where it gets fun, can be invested, right? Which is awesome. This is where real wealth really starts to get built. Um, so, what is investing? Like, what are investments? Like that's a huge, exciting world that I personally am extremely passionate about. I know, Dennis, you are as well.
Yep.
But man, there is so many things out there, from investing in yourself. That's one way you could, courses, education, stocks, bonds, crypto, real estate, a small business, a side hustle. I mean, if you are passionate about it, there's probably a way to make money doing it. There's people that make money, investing in YouTube channels and buying Pokemon cards. I mean, there's so many ways. Like, it's unlimited. Money is like almost unlimited in the world we live in today. So you just have to find a way to get to it, right? And or make it, or get a better return on what you have, which is all about where investing comes in. So yeah, I mean, Dennis, what do you think? What I just covered, and then like some of your favorite investments, maybe like, what do you think about savings, and to investing and emergency funds? What are your thoughts?
Yeah. Yeah. I mean, it totally makes sense. To start thinking about investing and your risk, I think risk tolerance is probably the most important thing to get out of that. So what are you willing to put into the market? Or if you're starting a business or investing in your education, what are you willing to do? And what will you consider to just to set aside the time and amount of effort into something?
Yeah. And what are you willing to lose too, right? Like, which is why that emergency fund is so crucial, because technically anything you're investing, you're saying, I'm okay losing this to an extent, depending on the risk level. Obviously you're trying to do everything you can to avoid that, but as soon as you put it out there, you're putting it at risk, right? So
yeah, definitely. I think it makes sense to just look into each of the things that we covered, I guess, before. So stocks, bonds, crypto, real estate, to see if you're not going to invest in your education at this point, or if you're not going to start a business and you just have this nest egg aside from your savings, well, yeah, you should have it work for you to do something, at least get like a 5 to 10% return, hopefully, each year.
Yep.
Yeah.
Yeah, I mean, do you want to just kind of break into like just an explanation of what each of those things are?
Sure. Yeah, we could start with stocks.
Okay.
So stocks are like, that's like I feel like that's the most popular investment to talk about among people with like 9 to 5s, or if they're just getting started or thinking about investing. It's like, oh yeah, maybe I should buy some stocks. So a stock represents a share for a company, a publicly traded one. So you can't just buy like, I don't know. The only company that comes to mind right now is like Ed Koch's or the Koch brothers types of businesses. You can't invest in that because they're private, but you can invest in something like Berkshire Hathaway or Apple or Amazon because they are publicly available. It's sort of the same process to start investing as it is to start saving. You have to open up, so you pretty much have to open up a brokerage account. And then from that brokerage account, you can transfer money from your savings or your checking, which hopefully you're just doing it from your checking and not your savings. But you would basically have to connect those accounts and then transfer the funds and then decide what stocks you want to invest in. And then from stocks, it goes into things like mutual funds, ETFs. I don't know. Do they have any other like baskets of companies that they group together? Those are probably the main ones, right?
Yeah, those are the pretty much
or REITs.
Like REITs. Well, REITs are real estate investment trusts. So there's definitely stocks out there that aren't just companies. There's There's also like investments, IBCs or something like that. They're like investment brokerage companies. So they like they loan money out to companies to get return on that money. And they usually pay high dividends, like 10%, 8% a year, or something like that. REITs are real estate investment trusts. So they hold multiple real estate holdings. So usually that is a company. They're like a property management company or something like that, that they have $18 billion in real estate holdings, and you get to own a piece of that. And those usually almost always pay dividends too. Those are dividend stocks. And dividends are when a company pays you for owning a piece of the company, right? So some stocks do not pay dividends. Some stocks do. If a stock just goes up in value, that's called secular growth, right? Like the stock has just increased. So your one share was worth $10, now it's worth 15. So you've seen a secular growth in that case of 50%. But to see that money and have a realized gain, right? You then would have to sell that share. So to back up a second, stocks have something called unrealized and realized gains. So when you buy a stock, any stock, it's sitting in your brokerage account, and it goes up or down, those are unrealized or gains or losses. So if it goes down 5% from when you bought it, that's an unrealized loss because you haven't actually sold the share. If it goes up 10%, 20%, 30%, that's an unrealized gain because you haven't sold the share. So you haven't realized any of that profit. So, and that's important because when it comes to taxes, you don't actually pay taxes on the gains or the losses until you've realized them. So if you were to buy a stock and then hold it for 2 months and then it goes up 30% and you then sell that stock, you've now realized a gain of 30%, right? So then the IRS is going to go to you and say, okay, you've made 30% on that stock. You sold it inside of a year, right? So this is another very important aspect, which is short-term cap gains versus long-term cap gains. And cap gains is just short for capital gains. It's another type of income that the government taxes, right? Outside of your W-2, you're going to get a 1099 from your brokerage company that's going to show these profits or losses. Losses will offset your profits. And that can actually get really complicated. You can play different games with that on the tax side of things. But the simple version is short-term, long-term. You hold it over a year, you pay a smaller amount of taxes. You sell it under a year, you pay a higher amount of taxes. It's almost double. It was 30% last time I checked if you sold under a year and 15% if you sold it after a year. Those numbers might be a little bit off, but you get the idea. So what did we cover? We covered stocks. Secular growth is when a stock goes just up. We covered short-term, long-term cap gains, and we covered unrealized and realized, right? So then some stocks also have dividends. So a dividend is when that company pays you for owning a share. So they take the money they're bringing in and they say, okay, we're going to pay out X amount of dollars. And the way your brokerage account will calculate that is percentage based on the share price. So if a share is worth $100 and it's going to pay out a $20 dividend annually, that's going to have a 2% return, right? Am I crazy or am I saying the wrong? No, that's if it's $1,000, right? It would be a $2, right? If it's 2%, that'd be 20%.
Yeah.
So, yeah. But so they calculate it based on the value of the share versus the amount of money paid out. And it says that's how people calculate the percentage of the dividend. So if a stock pays a 10% dividend, right, that means that if it's $100 share, it's paying out $10 a year, right? And then companies will pay those dividends either quarterly or monthly or semi-annually or annually. And that money literally shows up in your account, right? So without selling that stock or ever doing anything besides buying it, you are getting paid, which is something I'm personally a huge fan of. So another
Until
thing,
it's taxed.
yeah, yeah, and you do pay taxes on your dividends, right? So they come in. That's the same thing. You'll get a 1099 from your brokerage company at the end of the year that you got to give to your tax man or include in your TurboTax calculations to assess that extra gain, right? Because they don't take the taxes out for you. You have to pay them. So yeah, and then there's a couple of different ways you can make money on stocks that you probably won't run into. they're pretty, like if a company gets bought out by another company, sometimes they have cash payouts plus shares. Some weird things can happen. The
Hmm.
only other thing that is like a basic understanding, I guess, with stocks is splits, right? So you can have splits or reverse splits. And all that is when a company gets to a certain dollar value, sometimes they think it would be more accessible to the market if they brought the share price down, right? So they say our shares, like Tesla is a great example this year, right? Tesla got up to
Hmm.
a very high valuation where it was thousands of dollars. And Tesla decided to do, I believe, a 7-to-1 split. So they said, if you own one share, you now own seven, right? And all that is they've increased, let's say there was 1 million shares in circulation, and then they just increased that 7 times. So now there's 7 million shares in circulation. And to make that up to people already holding the shares, they give them an increase in shares. So now you have 7 times the shares you had before, but the value is also divided by 7 because the actual market cap, and a market cap is simply the total value of a company on the public exchange, right? So that is their market cap. So if all the shares outstanding are worth $3.2 billion on a given day, that is the company's market cap. That market cap stays the same before or after a split. So those shares are just divided equally. And then sometimes the opposite happens. Sometimes a stock is getting like run over and it's just getting super low and it's down to like 30 cents. And a company says, okay, this just looks really bad. No, we're getting mud thrown at us because our stock is 30 cents a share, $1 share. So they do a reverse split to bring the price up. So if you have 30 shares, they do a 10-1 reverse split. You're then going to have 3 shares, but those 3 shares will be worth 10 times the value because it's optics, right? We're emotional beings. People like don't want to buy a fractional share of Tesla. They want to buy a full share of Tesla. So they don't want to put their $1,000 into a stock they can't even get a full share of, right? So when it's $400 a share, now they can buy 2, way more likely to buy it. I
Yeah.
don't know if there's anything else. I think that's kind of like the basics of stock in a little bit of a convoluted way, but I think we covered all of it.
Yeah, pretty much. Yeah. Generally, you don't want to buy a company that's reverse splitting most of the time.
Usually no.
That's,
It's
yeah,
usually not a good thing.
no. Oil rigs, 3D printing. No, that didn't work out pretty well for them.
No.
Um, yeah, I think we did cover stocks pretty well. The next one is bonds. That's probably going to be a short one, but essentially, yeah, I don't know if you wanted to cover
Enough. You
that.
got it. You got it, man.
Yeah. So nice and dirty and quick. Bonds are just like promissory notes that companies or even governments can lend out to normal people like you and me. And essentially you loan them how X amount of money. So let's say you want to buy a $100 bond from the government. Basically, you give them the $100 and then they promise you a percentage return after a certain expiration date. So let's say you get, that's a good example. Like 15% within, well, let's tone it down. Maybe like 5% within 10 years. You'll
Yeah.
get 5% on top of your principal. But
Yeah.
again, you have to remember that we're accounting for inflation. So 5% within 10 years, that's probably not going to keep up with inflation. But
I
it's
think that's
something,
an annual rate of return, though. I think it's 5% a year in essence. I
is it a
think.
year?
Yeah.
Okay.
I think those numbers are calculated on annual returns. Just kind of like you
Okay.
pay on a credit card when you pay a 22% ARP annual.
Yeah, that makes sense then. So yeah, if you can find something that's above 3% a year, then you're probably going to do all right with a bond. So it's the reason why you would probably want to have bonds in your portfolio if you're starting out would be to basically just have something less volatile than stocks. Um, Although this isn't true for every market or every cycle within the stock market, but generally bonds do stay uh, very stable when compared to stocks.
Yeah. And you're guaranteed as long as that company or government is still in existence in 10 years, technically, right? Like
Mm-hmm.
the bond itself might go up or down. Like their 10-year offering, like let's say a government sells a 10-year bond. And then the bond may go down, right? So they might be offering 5%, and then there's a bunch of money getting printed and interest rates go way down. So now they're only offering 1%, but your bond that you bought at 5% is still worth 5%, right? So that's where like people, it's complicated, but you can do like option trading almost on bonds where you're projecting that the return is going to go down or up, and then you can like kind of do futures and pre-buy them. But the basic bond just pays you out a fixed percentage rate. Basically, it's a loan from that company or the government, like Dennis was saying, over a fixed amount of time, and it's a guaranteed bet, right? So that's why a lot of governments in the world own U.S. bonds, because the U.S. current like government and economy is considered to be the best in the world. So it's considered to be a very safe investment to buy U.S. bonds, which is why China and England, a lot of other big countries have a lot of U.S. bonds, because they look at it as a very, very safe investment. So they take a bunch of trillions of dollars and buy our bonds and dollars. But
yeah, they're basically just IOUs,
yeah,
pretty much.
it's like if you went out and got a loan from a bank, but the opposite.
Yeah.
That's how companies raise money
Yeah.
outside of stocks.
Mm-hmm.
So yeah, crypto.
Oh yeah.
You want to cover that?
Yeah. Yeah. So crypto in general, that's basically just digital currencies that are traded between individuals and not necessarily governments, although some may be getting into it. I don't know. There's nothing confirmed yet, but I'm sure they are. Essentially, with a cryptocurrency comes a digital ledger, which is known as the blockchain. So with that blockchain, it's essentially just like a what do you call it? Like a manual ledger that you have in front of you, like a book of all the transactions that occur within the network are recorded there, and then they're verified by computers and miners. So the miner would basically just be the guy who has a CPU, or, well, in the beginning, I guess, a CPU, but now they have specific computers to just mine things like Bitcoin or Ethereum or Litecoin.
Mm-hmm.
And they would verify each page within that ledger. So that each page would just be called a block. After a block is mined and it's verified on the network, it is now permanently on the public ledger that anyone can view. So that's pretty much the gist of crypto.
So a miner is pretty much just a person that's verifying the ledger, almost like you have a ledger for your bank account showing the list of transactions, right?
Mm-hmm. Yep. And then it's stored in a full node, which anyone can run, basically. And that full node is distributed throughout the world. So there are only like, I don't know, like 10 to 20,000 verified ones, but there are more than that with Bitcoin in particular. But yeah,
So
most people would yeah.
What makes it safe is that because that ledger, like let's say it was your bank account ledger, right, is being held by 20,000 people, right, at all different locations, and that the network, right, is going back to itself and verifying that all those transactions match, right?
Mm-hmm.
And that is what keeps that currency honest, because it's not one bank somewhere or one person. It's everyone has the same data, and it's constantly verifying against itself. And if something doesn't line up, it gets red flagged, right? So if someone tried to create like a fake Bitcoin and insert it, it wouldn't work because it wouldn't be on anyone else's ledger.
Right. And people can technically try to attack the network by creating their own fork or basically their own blockchain. It's just really expensive to do so with something like Bitcoin, but you could probably do it for like $20,000 to like $30,000 for one of the smaller coins per hour. But that's the incentive to mine at that point. You're pretty much like, well, why don't I just participate in the network and get paid rather than paying all this money to just create my own blockchain that I'm trying to force everyone else to follow.
Right. And which is just, it's not, yeah, it costs more money than it's worth. It's going to cost more than you're going to make in essence. So it's like self-defeating. Like, sure, you could try to do this, but what are you really going to make doing it?
Right. And the reason to use it, I guess, well, there are various reasons to use it in general, but most of the time, at least with a lot of the a lot of the countries that Alexander mentioned before, that are their currencies are essentially getting inflated away, so they have to use something a bit more stable. I mean, Bitcoin is nothing. Well, it's nothing we've seen before, so stability is still in question for sure, and the price keeps rising at this point. But it's much better to convert your pesos or your bolivar to something like Bitcoin because it's available worldwide, and it's not going to deflate or inflate
Sure.
because of their government's printing. Uh, with
Right.
something like Bitcoin, it's fixed, so there's a fixed supply, and the distribution rate is cut in half every 4 years. So there's less and less on the market to buy, which is pretty much why the price keeps increasing every 4 years.
Right. It's like a deflating currency instead of an inflating currency.
Mm-hmm.
Now, like with Bitcoin, like you were talking about, what the one thing that makes that very popular to certain investors and stuff like that is the fact that it has a limited supply, right? I don't know the exact number. I think it's, what is it? Some millions of coins or something.
21 million. Yeah, they're 18 and a
21
half, I
million.
think, right now. Yeah, 18 and a half
Yeah.
right now are in circulation.
So at that point, miners will no longer receive a coin. Like once the 21 millionth coin is minted, miners will no longer receive coins as rewards for verifying the network, right? So that's all. A miner is just basically someone that's running all these processes, in
Mm-hmm.
essence, in the same way that a Visa or Amex runs all the processes for every time you swipe your debit or American Express card or whatever you're swiping. And the way they get paid is they get one Bitcoin, right, after so many blocks are mined, which is so many pages, like Dennis was saying, of data is verified, because they're spending that money on electricity and all that equipment to do that, right?
Mm-hmm.
So back in the day when Bitcoin first started, they would pay out, you could get 1,000 coins pretty easily in the first couple of days for not verifying a lot because the Bitcoins were worth nothing, right? But at this point, like he said, there's that halving, right? And it gets harder and harder. You have to process more and more and more data to earn one coin.
Mm-hmm.
Um, that has increased the value of mining because the coins have gone up, but also the expense, which has caused, I guess, a lot of people to get out of actually mining as a hobby. And it's pretty much just run by major corporations in countries where electricity is very cheap and
Yep.
cooling is cheap too. Like very cold areas are good because you don't have to get rid of all that waste heat.
Mm-hmm.
Um, but yeah, but all crypto is not made that way. Okay. So just to be very clear about that fact, like Bitcoin has a set amount of coins that will be printed are minted, but not all currencies are made that way. So if you start getting into the crypto world, be very, very cautious and be very aware of what you're buying and what that altcoin, which is another word for any currency that's pretty much not Bitcoin,
Mm-hmm.
um, does, or what its function is, because all coins have a function, especially altcoins. Like they exist because they're going to do this or they're going to do that. And there's companies out there, guys, that create them. And sometimes they just issue a billion of them, or, they say, oh, we're going to tie this to the value of the dollar, or they can just create more at any point. So not all cryptocurrencies are created equal. Not all of them are, I'd say 95% of them will be worthless someday.
Mm-hmm.
So blockchain in itself is an extremely inventive and valuable technology that will be in use forever now. You know what I mean? It's just the way it works is brilliant. This Satoshi guy, whoever he was, if he was a single person or not, was a genius. But that doesn't make all cryptocurrencies are brilliant or valuable or anything like that. Like we just had XRP got sued by the SEC and
Right.
just got delisted from like every exchange ever. So
Yeah.
it lost like all its value overnight. And maybe they'll be okay. But that's a
Mm.
Bitcoin, a cryptocurrency that was they just issued it like a stock almost, right? Like the whole point of XRP was to basically allow transfer between corporations, I think was their whole bit, right? It was like supposed to be an easy way to transfer international money
Yeah, between banks.
between banks. And
Yeah.
they just created it. You know what I mean? So it's not made in the same way. And I think their blockchain works a little differently too. And not all blockchains are the same either, right? Like, so some people have improved on blockchain technology in a way because it's been around for a long time, right? So some cryptos actually can process more transactions a minute.
Mm-hmm.
Um,
But that doesn't
and
mean it's more secure.
no, it doesn't mean it's more secure. So there's a ton of stuff. It's its own world, and it can be a little bit scary and unnerving world
Hmm.
It's way more user friendly now with sites like Coinbase and stuff like that, who only list a fraction of the cryptocurrencies out there because there's thousands of them. And they kind of pre-verify a little bit before they let you trade some of those. They manage the wallets for you, so you don't have to have the wallet somewhere with your what's the passphrase you have to have to get to your wallet.
Oh, the seed phrase. Yeah,
Yeah, whatever it
the
is,
seed
something.
phrase, and then it depends on the hardware wallet or method you use
Yeah,
to store your own Bitcoin. But yeah.
which is why some people lose their hard drive with whatever's on it with Bitcoin. They can never access it again, right? Because that wallet's like locked forever
Hmm.
without that key. But so yeah, it's definitely more user friendly now. I think it's a good asset class if it's done right. Especially, I'm more a proponent of Bitcoin. Outside of that, maybe Ethereum and Litecoin would be the other top two or top five currencies out there that have a really good user base and pretty good security. And they tend to follow Bitcoin pretty closely. Like if Bitcoin goes up, they go up the same percentage type of a thing. Um,
Yeah.
but
Yeah.
yeah,
That's pretty much. Yeah. I mean, without Bitcoin, none of the other ones would even be considered or created at that point. So
yeah, no, it
whatever
started the whole
happens to
thing.
Bitcoin,
Yeah,
yeah. So whatever happens to Bitcoin, the rest of them either follow suit or they get utilized within Bitcoin's source code, and they use the features that work and don't include the ones that don't work. So
yeah,
the most conservative bet within cryptocurrency in general is just Bitcoin, and that's the only coin I have. So
yeah, yeah. And that is still a very volatile currency, right? Like,
hmm.
I think it's changing based on institutional investors getting into the game now. But still, if you look at what it did in 2018 when we had a spike to 19,000 and a drop back to about 5,000 in less than a week or something crazy, like it
Yeah.
is risky. It's volatile. It's definitely very volatile in the short term from the history of the coin so far. Now, do I think that it's a pretty safe 10-year bet, 20-year bet if, governments really decide they don't hate it and are willing to let it coexist with their currencies and don't come out with their own cryptos that they want to control? Yeah, I do. I think the biggest risk to crypto is just basically governments and greed. If they decide, no, I want to control all of your life and I want to know everything about you and where all your money is going at any given time, then it could run into problems. But it's international. Every country would kind of have to agree on that, like, because there's tons of people in China and Russia and the US and the, European Union. They're all using this, right? They're all holding it. So to just get rid of it overnight would be very hard. Like, yeah, if the US outlawed it, you'd see a huge drop in value in a day, but you'd still be able to use it in other countries. And it's very hard for them to do that too, because it's a decentralized currency. It's not being held by a central reserve. It's 20,000 people all over the world that have the same record. How do you take them all down at the same time, right? So
Hmm.
it has some very natural protections just in how it was created.
Yeah.
But governments are tenacious and they've done crazy things before. So look, nothing's a sure thing, right? That's all we're trying to say. If you are
Hmm.
going to get into crypto, please do a lot of research beforehand. And as Dennis says, if you're the safest, most conservative bet is just to buy Bitcoin. And I would say at this point, mining is not even worth getting into on a user level, just because the equipment's
Definitely
so
not.
specialized and the electricity is more than you're going to get back. Even if you join like a group or something like that, it's just not worth it. And the likelihood that you're going to mine some random altcoin that goes through the roof someday is so small. It's almost like buying lottery tickets. So, I wouldn't call that investing. I would call that betting or gambling. So if you can lose it and you're passionate about it, you think you got a hedge, that's up to you. It's your money, do whatever you want, but just don't consider it an investment. That would be my only advice. Like, consider it like, hey, I could lose all of this and I'm okay losing all of it,
Hmm.
So, anything else on crypto? Anything else that you wish you understood getting into it, or you think is confusing, or if you were just trying to understand it that you would want to know?
Um, I think, yeah, I think for if you're just starting, even with stocks too, the best way to learn is just to buy a little bit, and then you're sort of committing yourself to, oh yeah, like I have I have a good amount of money in this thing. I should probably learn about it. But it really depends on how much you want to put in. With Bitcoin, you can put in as little as like $5.
Sure.
I mean, it's not gonna. you're not going to lose sleep over putting in $5, but it might pique your interest to just
Have
learn a little bit more about
a
what's
little
going on
skin in the
there.
game.
Yeah, same thing with stocks. I mean, there are certain platforms that you can buy like $5 worth of Amazon or $5 worth of Tesla stock, but
Sure.
uh,
Fractional
yeah,
shares. That's called fractional shares. Robinhood.
hmm
That's a platform that supports that. A few others.
yeah,
I guess since we're talking, like, we should probably say, like, so is there any place that you would recommend that people buy their Bitcoin if they decide they do some research, they decide they want to put a little money into that game? Like,
yeah. It really depends on where you are in the states. Swan Bitcoin is available everywhere. I think all 50 states now. Yeah, they just got approved um, in New York. There's Gemini, Coinbase, there's Cash App. If you guys like Cash App, you could technically, everything we've covered, you can do within Cash App. You can have your direct deposit sent to Cash App. You can buy stocks. You can buy Bitcoin there, and you can send and receive money with your friends as well. You can get a debit card if you need that.
nice.
But yeah, I
Not
think
that we're
Cash App would
sponsored
be
by Cash App. It'd be nice if we were, but we're
one
not.
day.
But it's a great app.
One day. But yeah, everything we covered you can do in there, which is great, which is really great.
Yeah.
Uh, I think that's mainly it. Yeah.
Okay. Yeah. And for stocks, Cash App as well. There's also Robinhood and a few other apps out there. Outside
hmm
of that, there's the big boys. You got E Trade, which was just bought out, actually, right? Who are they with now? I don't
Is
know.
it Fidelity
Fidelity.
or
Yeah.
Schwab? One of those
Schwab, I
guys.
think. But they definitely have more robust platforms that'll expose you to things like option trading and futures and all sorts of stuff. Um, but yeah, there's definitely way more options out there for stocks. You can look at who you're banking with too. Sometimes they have brokerage accounts you can get access to. But definitely do some research before you pick one, just because once your money's in there, it's not necessarily the easiest thing to move around, and you're going to want to learn you're going to want to learn your platform and know how to use it and be comfortable finding the data you need in it. So
hmm
definitely don't take it lightly when you're picking a brokerage account. Do some research. Like Robinhood's like super accessible, but it's also super light on certain things, right? It's not going to have the same depth of analysis as, some like an E-Trade account will. Like E-Trade, you set up an account, you're going to get a free downloadable uh, stock trading engine that's going to give you up to the minute reports on how things are moving, and you'll be able to see way more data on how many shares are sold short, or I guess short share. If you sell a share short, Sally sells seashores by the seaside. If you sell a share short, that just means you're betting against it. You're betting it to go down, right? So knowing these things and seeing different versions of charts can tell you a lot about what a stock's going to do. So yeah, if you're just buying for a super long term, none of that matters as much, but it's still good to kind of dig into companies. You want to look at financials and stuff like that. So
hmm
whatever brokerage account you choose will give you different levels of that support, right? So,
Yeah. Yeah, we
all
could
right.
go on and on with
Yeah.
stocks and stuff, but I'm sure there'll be more videos about that, like more in-depth stuff. But
So
I don't
real
know.
estate.
Oh yeah, real estate. I cannot claim to have bought a house yet, but but yeah, you
uh,
can get exposure if you don't have money to gain exposure to buying a full-on house. You could do REITs, and they
sure.
pay. I think it's like what 90% of the profits for each. Well, throughout the year or something like that.
I don't, yeah, I don't know if it's a fixed percentage of the income. I think that's up to the REIT.
Yeah,
But
I know that.
they do
Yeah,
pay a dividend, right?
yeah, I do know that they have to pay the majority of it. It's something like 80 to 90%. So that's why the yields on them are pretty high most of the time.
I was employed by a REIT. I never got into that side of it, so I'm
Mm,
not really sure. But I know even years where they're not profitable, they still met their dividend. So by borrowing money. So I'm not really sure. It's not like fixed. Maybe if profit comes in, they do have to pay a certain amount of that profit, but they can still meet the dividend even if they didn't make that profit. I'm not sure. Obviously, companies are motivated to keep their dividend the same, because if they cut their dividend, a lot of people will sell their shares, and that will devalue the stock price.
hmm
Um, but yeah,
hmm
and you can pick REITs for certain areas, right? Like certain REITs will have really big exposure in the Northeast or in a specific state or to a specific type of real estate. So if you really like commercial investment in Detroit, You think that market's going to blow up. You can find a REIT in Detroit
Oh
just
boy.
by going online and looking for, hey, what's a REIT in Detroit that holds a lot of commercial real estate? Or you want the residential market, or you want to get into extended like health, like end of life care. All those people have buildings. There are REITs that own those buildings across the country, right? There's REITs that own malls. There's REITs that own hospitals. Like if you like, you can get massive exposure to specific markets, to specific types of real estate in specific geographic locations through REITs.
Hmm.
Um, Obviously, return will be fixed to an extent. They're going to be that dividend payout. Usually, REITs are like 3 to 15%. Obviously, if it's paying 15%, it's probably a higher risk, right? Because it's really high. It's
Hmm.
hard for them to sustain that. And something like 3% can be conservative. Most times when I buy REITs, I'm aiming for like 7 to 8%, if I'm being honest. And yeah, it's a great way to get exposure to real estate without necessarily being in real estate. Um, there's also a lot of networks out there nowadays where if you want to like get into a fund with like a local investor that's fundraising, you can find a local network on maybe Reddit or some of these other websites that are just for, real estate investors, and they have people going out to buy a house, and you can, put up some funds with some other people and maybe get a 10% return to help fund their flip or their investment property. And you can find a lot of those guys on YouTube, and, just do your
Hmm.
research, make sure they have good reviews, and, obviously you're taking a risk, anything you're doing, but protect yourself as best you can. Um,
Hmm.
yeah. And then if you get enough money saved up and you actually want to buy an investment property, that's kind of like the third stage of that, right? And then there's two main ways that most people invest in real estate. There's flippers and there's long-term holds, right? And then there's a billion different ways that people do other things, and you can get in cheaper. You can bird dog, where you like go out and you find houses for investors and you call them, you get a percentage if they buy it. That's more like working, honestly. You can become a
Yeah,
real estate.
plenty of
Yeah,
jobs in real
there's
estate.
there's so many things. You can become a real estate broker. You can become a real estate agent. You can leverage different things. You can literally go out and make offers, get properties under contract, and then find someone to buy that contract for more money. But those things are hard to do, and you're only going to make a couple $1,000s probably on each one, and you're going to have to go through a lot of deals before you get one. Just speaking from experience. So the best way I think to invest in real estate, and the simplest way in a lot of ways, is just to buy rental properties, right? So identify a market you like, look at a lot of properties, do your research on like what your expenses are going to be, what your taxes are, what people in the area pay for their water bills and their heating bills and for their garbage pickup, and what is it to get the lawn mowed. Once you have a really good understanding of what that is and what your rate of return is, real estate can be a great investment, right? As my grandfather always used to say, like, they're not making any more of it. Like, there's only so much land. It's kind of like Bitcoin in a way. Like, they can't inflate the land, right? Like, they can't just be like, we're going to extend America by 100 miles. Um, in
Tempting
fact,
to buy.
yeah, and those didn't work out so great. They're sinking. But
Oh.
and if global warming continues, heck, there's going to be less of it. So maybe just don't buy on the coast, because maybe the coast will be farther inland in a few years. Uh,
Yeah, I mean they've been saying that since the '80s, so I don't know.
yeah, not to get political in any way, shape, or form.
Yeah,
So yeah, so I, for instance, own two real estate investment properties. I own a duplex and what will hopefully be a triplex. It's currently a duplex, but I'm working on turning a side area into a third room or unit, like a little like one bedroom thing. And I own my properties down in Virginia and a certain area, just because that's where I found the best value on buying properties, a good increase over the last 10 years in property values, and the taxes were way lower than they are for me here in New York. So my ROI, our return on investment, was better, right? So yeah, there's a lot of things that kind of can go into it. It's usually there's always going to be some kind of a problem. There's risks to it, but at the end of the day, real estate investing can be a very conservative, consistent play, right? Like like we talked about at the beginning, like a house in 1950 was $3,000. That same house today is worth 650,000. The house didn't change. Everything in the house is older. You know what I mean? The 2x4s are older, the sidings, but it's worth $650,000 over 70 years. Now, that's a long time, but over 30 years, if you look at house prices across America, even though we've had some dips and some stuff like that, like house prices are higher because inflation keeps going up, right? And that real estate, there's more people, right? Our population grows and there's only so many houses. And this can be exacerbated in certain areas where you have large influxes of people, like Texas, right? Like a lot of people are moving to Texas right now, into Nevada, fleeing states like California and New York, or to Florida. So you have these booming economies where houses prices double sometimes in like 3 or 4 years, right? And then you have places where it just goes up 5 to 7% a year. It's all up to you. And then look, the market can turn, and you can have 2008 and houses can go from being worth 500,000 to being worth 250,000. Like where I live, that happened in 2008. A lot of people overextended themselves, but if they had been able to hold and rent those properties, right, and at least cover the cost of their mortgage for the next 12 years, by 2018, house prices here were back to where they were in 2008, right? They got back to where they were. And if you had been able to rent that property that entire time to at least cover your mortgage and your taxes, it wouldn't have cost you anything. You would have owed less, and now your asset would have been worth what you paid for it. So it's a long-term investment. It's not necessarily super sexy or glamorous, right? But it usually offers pretty solid returns of, for me, I want to see 10 to 12% ROI, return on investment, on whatever I buy, right? And other people calculate that as like a cash on cash return. So let's say, here's the other really powerful thing about real estate. You can go out and get a mortgage, and pretty much anyone can get a mortgage as long as their debt to income ratio isn't too bad and they have a steady job, right? And it's one of the lowest interest rates in the world. Like no one's going to let you go out and buy stocks, at 3.5% for 30 years. And you go up and you show up with 40 grand. And they're like, all right, we'll give you 200,000 on top of your 40, go and buy stocks and just pay us back over the next 30 years. Like no one's going to do that. With real estate, you can show up and the bank will say, yeah, okay, you want to buy this house? You say, yeah, sure, I want to buy this house. They're like, okay, 20% down, 20%. So if you can buy a $200,000 asset for $38,000, $40,000 with closing costs, like that's a huge win. So if that $200,000 asset, right, rents out for $2,500 a month, and you look at that ROI versus the 200,000, that's a decent return. You know what I mean? But if you're looking at the fact that you bought that asset for $40,000, right? Now you're making $2,500 a month on 40,000. That's a much better rate of return, right? And that's your actual cash into the deal. So that's why real estate, even if you're, let's say, breaking even, which means like your rent only is covering the cost of your mortgage, your real estate taxes, and your upkeep, right? You're still making money because you only put in, let's say, $40,000. You're going to have in 30 years, $200,000, and you never put in anything more than 40 grand, right? So now after 30 years, you have an asset paid off that's worth 200. That's what you bought it for. In 30 years, it'll probably be worth more like 350, maybe $400,000, right? Because the value of that property is going to go up. You're going to have been able to write off your tax losses every year because you're going to be able to devalue the property, right? Which is going to lower your tax bill. So there's lots of, and that's just some of the stuff, right? This is kind of like a basic getting into it. Hopefully it makes sense, but there's a lot of advantages and there's a lot of ways to make money, even if you're not quote unquote making money. But it's not impossible to find deals, right? They're good deals where you do make money. So not only are you paying that asset down, someone else is paying your mortgage. Not only are you paying, you're getting a refund on your taxes every year because you're now able to write off depreciation on that property and stuff like that, but you're also making money every month, right? So passive income. If you can bring in like let's say the one property that I have, right? I bought it for $180,000. I put 38,000 down. I put another 30,000 into renovating it, right? So I'm at 68,000. It cash flows $3,700 a month, right? $3,700 a month. My taxes and mortgage are $800 a month. And then my property manager and my other stuff brings me to about $1,500 to $1,600 a month, all in on expenses, which means that I'm clearing $2,000 a month on a $68,000 investment, right? So in a year, I'm going to make $24,000, which means in 3 years, um, I'll be way ahead, right? I'll have more money back in 3 years than I put into the deal, and it will still be making me money. I'll have all the cash back I put into it, and I still have monthly income in an asset that's being paid off. You know what I mean? So I'll have that cash value in 30. So just think about, like, if you're trying to retire, right? And you were trying, like, outside of your 401k, if you can today buy an asset, like if you just put $68,000 into your retirement account today and you didn't touch it, you just saved. And this is why savings hurts you in the end, right? And you did nothing else with that money. When you get to 65, you just have $68,000. If you bought a house, just one investment property, let's say you just do this one time and you never do it again, okay?
Mm-hmm.
You've now made $24,000 a year for 30 years, okay? So how much money is that? Every 10 years, you're making $240,000. You've made an extra like $680,000 over 30 years. You now have an asset that's completely paid off, that's still cash flowing, that was worth $200,000 when you bought it. Let's say conservatively it's worth $400,000. So you've turned 68 grand into $1,000,000 of income over a 30-year period. That's an incredible return on investment. And that doesn't count, like, that's just the value of the house and the value of your income. That's not your tax write-offs. That's not so many other things. So investing is so powerful. Like, it can change your life. It can change how your later years are lived, because now you could take a reverse mortgage out on that property right now that's been paid off. You can get income off of it for the next 10 years where they're paying you to basically they own the house when you die, if you want to do it that way. Plus, during that whole period, you're still getting $2,400 a month in income. And that's saying that the rents never go up, which is probably in no way is the rent not going to be higher in 30 years. So, right. So in 30 years, that asset's going to be worth, maybe your rent income's $3,200 a month, right? And then after that 30-year mark, if you don't have a mortgage, well, guess what? You're making an extra $800 a month. So now that house is paying you. Let's say after 25 years, you're clearing $4,000 a month on that house, right? That is completely within the realm of possibility. It's worth way more than you paid for it. You've never paid a dime towards it. You recouped your money in 3 years. Like, or you have your money sitting in a bank account and you have $68,000 in 30 years. That's the difference between investing and savings. And the same thing is true with stocks, right? Like, if you look at the market over the years, like from the beginning of the stock market, right? It's a little bit different than real estate, but at the same time, it takes less work. It's easy to do, but it averages 10%. Right. So even if you just stuck in the stock market, you made 10% for the next 30 years, that compounds, right? So you've made 10% on top of 10% on top of 10% on top of 10%. And over 30 years, especially if you're reinvesting your dividends or anything like that, that 68,000 is going to be worth hundreds of thousands of dollars. It's life-changing. And if you can get that and you can understand it, you can literally think and grow rich, as the book is titled. Like, it's such a powerful tool, and it's available to every single one of us. You know what I mean? There's not, like, yes, is it harder, and do you need some kind of, yes, but if you just do it, if you think about it, if you use your head, if you, like, get in the game and you learn and you want this, you can have it. I promise you, anyone can have it.
Definitely. No, yeah, that was really great. Really articulated well. Yeah, I think I guess the main difference that would make sense to communicate to you guys is that if you are going to buy real estate, you can't think of it like as a stock. You're not going to see a price ticker every day with your house. So if you are going to do real estate, you should just consider it like just as a business.
Yeah.
You can't just check up how much it's worth every day. It's the same thing with stocks. Like, you shouldn't be looking at your portfolio every day, because hopefully you're not day trading every day, but that's like a whole other thing. But if you're going to invest for the long term, you shouldn't be looking at this stuff every day. You should just be working towards saving as much as you can and investing as much as you can.
Yep. And diversifying, right? Like, so, as great as stocks are, as great as real estate is, as great as crypto is, personally, I don't think you should be 100% in on any one of them, right? Because we never know what tomorrow holds. So, you know, um, maybe a hurricane hits somewhere and you lose the house, or maybe some president somewhere does something really stupid and the stock market tanks, so, but if you're diversified and you have a house or two and you have hundreds, a couple hundred in stocks, and you have, some safety bonds, and you have that emergency day fund, and you got a few Bitcoin, you know what I mean? Like, maybe that happens in the stock markets and that pushes crypto up 1,000% over 3 months. You know what I mean? But so yeah, you lost, but you didn't lose. You know what I mean? You protected yourself, or vice versa, right? So you're minimizing, you're min-maxing a little bit, right? Like, you're minimizing your maximum gains. If you could totally predict the future, sure, you could buy this thing and it would give you the best return, but you're also minimizing your risk to an extent, because you can never
Mm-hmm.
lose all of it. And if one goes down, the other one's probably going to go up, and vice versa.
Mm-hmm. Yeah, I think wealth preservation based on your risk tolerances, that's the way to think about it,
Yeah.
mainly. Yeah.
Because some guy explained to me once, he was like, like, if let's say you made a really good bet in the stock market, right? And you put in $50,000 and you bought one stock instead of diversifying, and that stock went to 100,000, right? And you sold it after 6 months, and then you bought another stock, right? And that one goes to 200,000, and you did that in 3 months, and then you buy another stock, right? And it goes down 80%. You picked a loser, because that's going to happen at some point, right? So now you have less money than you started, right? And you
Mm-hmm.
wasted 2 years. So you have 2 years, and time is a huge factor with any of this investment, right? The more time you have, the more money you have at the end of the day. If you had instead diversified and just made 10% a year, right, over 2 years, yes, would it be way less sexy? Would you have made those huge gains and huge losses? No, but you wouldn't have lost 2 years. You'd have, $70,000 from the 50,000 you originally invested. And you wouldn't, the other guy's down at 45 and he's lost 2 years. He's got nothing to show for it. So it's like the tortoise and the hare scenario, right? Like, our whole culture today is really bent on, like, I want gratification and I want it now, like, very
Mm-hmm.
short attention span, in the way, like, they want to get in, they want to play the stock market almost like gambling, and they want to see, like, a stock go up 100% in a day or 40% in 3 weeks. It's like, well, that's not investing. Like, that's gambling, and that's not the game. Like, this is a 20-year game. This is a 30-year game, right? This is a 15-year game, and
Mm-hmm.
when you're buying consistently, you're dollar cost averaging, stuff like that, you're just putting that money in, it just builds. It builds this thing for you, which is secure, diversified, strong. And, when you get to your golden years, or your 40s and your 50s, you got something really valuable there. So you can spend time with your grandkids, or go to climb mountains, or do whatever you want to do, right? Because you built something that's going to last.
Mm-hmm. Yeah. I think we covered basically everything. I don't know if there's anything else that we should cover, but yeah, just don't be a TikToker. I've seen finance TikTokers. Unless you're making money off that, sure, go ahead, go for it, I guess.
Yeah, like, don't go out and, like, to do research, go on Reddit and do what was it, Wall Street bets?
Yeah,
Don't
don't do that. Don't
don't
uh don't don't try to lose money on purpose.
yeah, don't go out and buy options, having no idea what options are, and make a long bet on some car company that's making the new electronic engine just because that's all the rage right now, right? Like,
Yeah.
invest like the trends of the day, because someone out there that's way smarter is going to pump and dunk that stock, and you're going to lose your shirt. Like, it's the way it works. So yeah, we'll get, over the next, as this podcast goes on, we're, hopefully going to really dig into some particulars on each of these things, and, like, how to do this, what not to do, best practices, but those are your basics, right? Your main building blocks in today's world of what's considered investments, stocks, bonds, crypto, real estate, your own business or education, you know, savings, what it is, how to do it, budgets, what it is, how to do it, and, some basic things where, different trading platforms or crypto exchanges that you can look at. And then, yeah, just go out and do some reading. I mean, there's blogs everywhere on a lot of this stuff. It's the age of information, right? There's a billion YouTube videos out there there's just stuff everywhere. You just have to go out and look for it.
Mm-hmm. Yeah, this journey starts with you. Just keep in mind what you want to accomplish out of this. You have one
Yeah.
life. Like, what are you gonna do with it?
Yeah. No, that's crucial too. Like if you don't, like, you can't strive towards a goal if you don't have a goal, right? Like if you don't know where you want to be, how can you ever get there? You know, that, I mean, that is so crucial, Dennis.
Mm-hmm. Yeah. Yeah, that's probably, well, that could be a separate podcast, but yeah, that's probably one of the most important parts. We just skipped it, but that's fine.
Yes, goals.
Goals, goals.
Cool. Well, yeah, I hope you guys enjoyed this first one. I'm sure we will get better at this as we go along. And but if you didn't mind our voices and a little bit of nerdiness on investing and savings and what budgets are, and you know, then maybe this podcast is for you. I don't know. And I hope you'll come and join us again sometime.
Yeah, make sure you guys like and subscribe. Push that, I don't know, push that bell button. I guess that's what they have, right?
Bells, thumbs
What?
ups, whatever platform it's on.
Smash it.
Smash the like button. For the YouTube algorithm or whatever.
Yeah. Thanks, guys.
All right. Have a great night. Well,
Bye.
whatever time of day you're listening to this at, have a great that.